4 million American families have claimed a $1,000 government deposit for their newborns in the last few months alone. Most of them spent less than 3 minutes on IRS Form 4547, assuming they were opening a standard, tax-advantaged savings account for their child's future. That simple form is backed by IRS Notice 202568, a separate document that classifies these funds as a traditional individual retirement account, a structure that governs every withdrawal for the next several decades. While the seed money is real, the trade-off is immediate. Accepting the deposit locks the account into a system of rules that parents cannot modify or override. The frictionless sign-up process trades a quick payout for a long-term set of regulations governing exactly how this money behaves until your child reaches adulthood. For 18 years, all funds must remain in U.S. equities, like an S&P 500 index fund. Parents are legally barred from shifting into safer assets like bonds. If the market stagnates, the account cannot shift course, potentially leaving the child with diminished purchasing power. Standard 529 plans avoid this by automatically moving money into less volatile investments as the enrollment date approaches. By mandating a high-risk, equity-only strategy for nearly 2 decades, the account operates as a financial straitjacket that ignores age-appropriate risk management. On the day a child turns 18, the legal title of the account transfers instantly from the parent to the teenager. The teenager can choose to liquidate the entire balance immediately. If parents have contributed $5,000 annually, that balance could exceed 6 figures, and the parents have no legal standing to prevent a withdrawal. This traditional IRA classification is critical. The IRS taxes every dollar of growth as ordinary income. If the child pulls $60,000 for tuition, the tax bill exceeds $7,000. The penalty is waived, but the income tax remains. This tax treatment places educational withdrawals at a significant disadvantage compared to standard college savings plans, which typically allow tax-free use of the growth. This chart tracks the cumulative taxes paid over a 4-year degree when using $5,000 in annual contributions. The gap is substantial. Using this account for college costs $25,000 to $35,000 in taxes, avoided entirely in a 529 plan. The only mathematically efficient path for these funds is a Roth conversion. At age 18, the child must convert the balance while they are in a low income tax bracket. If that money then sits untouched for another 41 years, it can grow into a tax-free retirement fund worth $500,000 by age 59 and a half. This long-term strategy relies entirely on a teenager's self-control, backed by the political weight of the account's name and its unique legal structure. Institutional trust is often built on speed and simplicity. Trading decades of wealth and financial control for a 3-minute sign-up is a choice that usually only reveals its cost 18 years later.